statutory income. The first one is the capital gains tax. Australia does not have a separate capital gains tax legislation. It has an income tax levied on gains made when dealing with capital assets, and there are 41 different events which can give rise to the Act being activated. Some countries, for example the United Kingdom, have a separate tax regime, value added tax, VAT. Our capital gains tax affects a taxpayer's income because assessable income includes the net capital gain from an income year where a capital item, tree, has been dealt with in a manner which gives income or fruit, or even a loss, lack of fruit perhaps we could say. The majority, I should say, of the capital gains tax events arise or result from something happening in relation to the asset, such as selling your house. The definition of a capital gains tax asset is in section 108(5), being any kind of property or a legal or equitable right that is not property. This includes goodwill, options, debts, choses in action, an interest in an asset, and even rights created under a contract. The definition includes foreign currency but excludes specifically Australian currency. The total capital gains and losses that arise in a year are used together to calculate a taxpayer's net capital gain or loss. The net capital gain is then included in their assessable income. Section 104 sets out the events, identifies the exceptions such as the sale of the taxpayer's main residence, ordinary motor vehicles and motorcycles, personal use assets other than collectibles under $10,000, compensation for personal injury, proceeds of life insurance policies, depreciable assets such as plant, which we deal with in topic 12, capital allowances and assets used to produce exempt income under section 118(12). The Act then gives the steps using cost-based adjustments and the circumstances where rollover is available for a loss usually. The main event is disposal, which is sale, end of an asset through loss or destruction, the bringing into existence of a capital gains tax asset such as contracts, trusts, leases, shares, and then special events such as forfeiture of a deposit, residency ends, followed by special rollover provisions where a corporation ceases to be part of a wholly owned group, and other events such as balancing adjustments events on depreciating assets.